We're live. Good morning. My name is David Shaneberg, and I'll be moderating the next panel. Are we live?
I believe so.
Okay, I'm going to assume we're live. I'll be moderating today's panel called The Year of the Add-on. We have a great panel of speakers today. Chad Crank, Joe Rondinelli, and then Sean is going to be signing on momentarily, dealing with a few technical issues. We have about 30 minutes today, so I think we'll just dive right in with introductions. My name is David Shaneberg. I'm a principal at Balmoral Funds. We are a Los Angeles-based private equity firm that focuses on special situations investing. We make control investments in good businesses with a challenging dynamic. So that includes corporate carve-outs, distressed businesses, and undermanaged businesses where we think there can be a benefit from new leadership and a new vision. Investing out of our third fund, which is a $233 million fund. And with that, Chad, why don't you introduce yourself and then pass it on to Joe. Chad? Chad might have frozen. Joe, can you hear me?
I'm happy to do my background. Joe Run, I'm a principal at Frontenac. I've been at the firm now. We primarily invest in companies with $3 to $20 million of EBITDA, focused on business services, investments, industrial, food, and consumer. We're investing out of fund number 11 and are in our 50th year this year. So I'm looking forward to today's panel and discussion around add-ons. Chad,
you want to jump in intro?
There you go.
Good. Hopefully this will hold out here. So I'm Chad Crank, I'm a managing director at Grain Management. Real quick on Grain, we're a sector-focused private equity firm. We focus on telecom, media, tech, but primarily telecom and kind of telecom infrastructure-like assets. Been around since 2007. We're currently operating out of our 8th investment fund, private equity fund. It's a $2.3 billion fund. We just raised it about 6 or so months ago, so kind of in the early first or second innings of that fund. We've done a couple of deals out of it at this point. Overall, we've got about $6 billion worth of assets under management. And again, primarily kind of control deals, telecom infrastructure-like assets. Prior to Grain, I was head of TMT investment banking for Stephens, and so in that role, split between really kind of M&A advisory, worked on about $100 billion of M&A deals in TMT, and then principal investing, in the telecom sector and media sector. So this is kind of the area that I'm pretty narrowly focused in at this point.
Thanks, Chad. And Sean Dominic from Avathon is having some technical difficulties. So when he gets his audio visual stuff figured out, we'll have him introduce himself. In the meantime, I think we can just dive right in. So as was mentioned, today's panel topic is private equity add-on acquisitions, the year of the add-on, and we'll talk about add-on acquisitions both in general and then through the lens of COVID, because I think everything right now is through the lens of COVID, and we have about 26 minutes left, so we'll just dive right in. There's a lot to talk about here. Capital's been cheap. There's the potential for tax changes, and then obviously there's COVID. But I think we'll start with valuations, just to piggyback off of a prior panel that was going on earlier. And so, Chad, why don't we start with you? Maybe you could describe a bit how you've seen valuations differ, both for platform acquisitions and for add-ons, and how you've reacted to that valuation spread.
Yeah, absolutely. So, I think it all depends on what time horizon you're talking about. Let's say the last year or two. I think we've seen across the board, from the public equity markets to almost every measure of private markets, pretty substantial increase, probably 25, 50% on a multiple basis, something like that, depending on the subsector. And obviously those subsectors, were influenced by COVID, and we'll talk about that later on. Telecom, where we spend our time, I think is probably one of the beneficiaries of COVID in some ways, right? Because I think, the work from home trend, the essentiality of telecom networks, this conference that we're hosting virtually is hosted from Home and Business Connections. And I think we saw an influx of interest from investors into this space, seeing how resilient it is. But across the board, you've seen, even outside of our sector, valuation increases just in general. And then within the sector, what we've seen, and as it relates to this panel, really a premium being placed on platforms, and it's hard to exactly say, how to define a platform and actually what that premium is. But in our space, I would say it's at least, 2 or 3 turns, a multiple, increase on maybe what might be otherwise a 10 to 15 or 20 times business. So real value being placed on platforms. And I think that platform definition probably varies a little bit, but, a management team that's going to stay on, that has a proven track record of growing the business, enough scale. And the scale points, I think, are a little tricky, right? Because you got smaller private equity firms looking for smaller assets and bigger ones looking for obviously bigger ones. But, probably in at least in our space, in the $20 million of EBITDA, something like that would probably qualify in my mind in our space for a platform. And below that, pretty likely that that's going to be looked at from an add-on perspective, although there's certainly exceptions to that. And so, lots of pressure on that valuation for the platforms. And so that's led us to look at a lot more add-ons for our portfolio companies. I know we'll spend a lot more time talking about specific examples, but we've just seen that they're less competitive from a process perspective at times. Maybe it's not a banker-run process, or maybe it's just not as frothy of a process. You're less likely to see, really preemption from other private equity firms in those processes. And so, I think it makes a ton of sense for our portfolio companies to look at add-ons. May I pause there?
So Chad, from a valuations perspective, it sounds like you've seen platform acquisition valuations tick upwards, but perhaps the add-on valuation ranges have remained fairly steady. And so there's been something of a divergence there, and makes sense to try and deploy more capital to add-ons. Is that right?
Yeah, I think I would say that both have increased. But, if you were to track them, the spread between platforms and add-ons, I think, has increased over the last, let's say, 24 months or so. But all of them have risen as well. Just anecdotally, if I were to think about it, I'd probably say, and it definitely varies by subsector, even within our industry. But add-ons might have increased by, let's say, 25% on a multiple basis, but platforms might have increased, close to 50% on a multiple basis over that time period. Something like that. I mean, that directional spread, right, is sort of what we've seen.
Yeah, I'd agree with you, Chad. I mean, we see the same thing. The valuations for platforms have gone up, and of course, valuations for some of these add-ons have gone up. And it just goes back to the fact that, public markets are at all-time highs. People are trying to figure out where to put their money, and there's nowhere to get yield. And, there's more and more private credit funds out there. So capital's, in plenty. And I think to get capital deployed and, paying bigger prices, even for some defensive growth type assets, even if, they may not be hitting their or modeling out their targeted return. But to get there, people believe, we can deploy more capital into the core investment with add-on acquisitions and drive equity value creation that way.
And Joe and Chad, are you guys, what are some other trends that you guys are seeing, or factors that are driving your disposition towards add-ons versus platforms, other than valuation?
At least for us, I mean, it's hard to find platforms in competing in auction processes. So, in some cases, our strategy is to build the platform and put some of these add-ons together and create what looks like what is an integrated operating company. So I think you see even larger funds executing on this strategy because it allows them to get capital deployed, even if it's not perfect. But I think COVID has also caused some owner operators to say, I'm exhausted and taxes are going up. Like, let's see what our business is worth right now.
Yeah, those are some great points. I mean, the taxes, that's a whole path that we could definitely go down, but I definitely see that, being a driver of consolidation at the lower level, people selling in to that. And that probably is more driven on the add-on side of it, just anecdotally, because it's founder, owner, operators, people that want to exit the business. And I think generally by definition, those are going to be better candidates for an add-on than they would be, for a platform type of a deal. And the other point around sort of the sourcing side of it, I think that it's maybe affected platforms versus versus add-on in different ways around COVID, right? So the smaller company that may not, the family-owned company that may not be as connected to the capital markets, to bankers, to conferences, that's sort of in that flow, if you will, of deals versus the platform, and just sort of stereotypically, might be a management team that's very connected, they're scale, they're in the flow, those kind of assets I think are going to go for premiums just because they have a network effect. People know them, they've interacted with them, versus the smaller add-ons who are a bit less well known and connected. I think that divergence probably got exacerbated during COVID, right? As it's harder for companies that don't have those connection points to be out there and to bump into likely buyers. And I think that's led us, we can point to some examples, and maybe we'll do some case studies later on where, one of the deals that we did, I think definitely fits in that category of, just sort of a lesser known asset, but still a high quality asset.
Did either of you guys get an acquisition done during the COVID era of a platform, or did you focus exclusively on add-ons?
Yeah, I go first. One thing we got accomplished, I mean, we're very investment thesis focused investors. Same with Sean, and he'll tell you about that when he hops on. But so we're really targeting sectors, and prior to COVID, we were very much interested in the IT managed services space, like a lot of folks are, given some of the attractive business model characteristics there. But COVID hit, and people didn't know what to do, and we're partnered with an executive, and we're focused on an industry, and we were able to build relationships with folks, and there's consolidation going on in that market, and we were able to get a platform done last September, so a little bit after the initial wave of the pandemic. But as part of that, our thesis was, given how fragmented the industry was, we wanted to have a robust add-on acquisition pipeline to get to scale fairly quickly. So we ended up starting smaller than we usually would for a platform, but and in some other cases we do this, we have a very targeted add-on approach, so that as we diligence a platform, we can really hit the ground running and get those acquisitions done early, that first year of our ownership, so we can get them integrated and growing. It wasn't easy, and it was all generally done remotely, but we've accomplished a lot in what could be a people view as a very difficult time.
Yeah, we've been able to still get deals done during COVID. It's definitely made it a little bit more challenging at times, and particularly early in the cycle when we, I think less was known and how to do this, and we were all trying to figure out a lot of things all at once. But we've done, I guess we've closed 2 platform acquisitions in our current fund, and then we've signed one that'll close fairly soon in the next few weeks or so. And then on the bolt-on side, we've done 2 bolt-ons. One was already in process. It was already signed and closed, but we integrated it during during COVID, which I think kind of creates its own challenges. And then another one we truly signed right in the middle of COVID. I think it signed June 2020, so right in the middle of COVID, and we had to do on-site diligence and some things like that during COVID.
I think Chad may have frozen. Joe, can you hear me?
And so, can you hear me okay now?
Yeah, go ahead.
Okay. Yeah, the one that we actually executed during COVID, I think the one asterisk, if I were to put it on that deal, as far as having done it in COVID, was that we
prior to the deal. And out there.
Thanks, Chad. You're cutting in and out just a little bit, but I think we got the gist of it. And then I could speak a little bit from Balmoral's perspective. We're a special situations fund, so when COVID hit, we started seeing a massive uptick in opportunities. But it was really hard to parse out what was what to make of the pandemic's impact on businesses across different industries. And some things are more clear now in hindsight. We ended up making one platform acquisition in a chemical space. We bought an undermanaged division of a chemicals company owned by Koch Industries. And it was really, in a lot of ways, sort of a typical Balmoral deal, in that it was a special situation. It was a good business. It had been impacted by COVID, but that's not really why it was in the situation it was in. It was undermanaged. It needed a corporate carve out and to be stood up. It needed new management. And those are some hallmarks of a Balmoral deal. So somewhat contrary to what some of the other folks on the panel experienced, because we're special situations investors, we ended up paying a lower valuation, at least from a multiple perspective, for the platform. Because it was hairy and it needed to be carved out, stood up, and a number of other things. And then we paid ironically, a higher multiple for a bolt-on acquisition that we made in May, although still a reasonable valuation and probably more in line with the valuation multiples that Joe and Chad have been referencing.
Yeah, we as a firm, I think we got I want to say four platforms done in 2020. We were able to actually get 14 add-on acquisitions across all of our platforms. So, essentially one a month, which is hard if you think about it. So, having a very direct programmatic, focus add-on acquisition is, I think, key to driving value, and definitely in where we play in the lower middle market.
So Joe, let's talk about that a little bit, because the next topic we're going to turn to is the topic of identifying add-ons. And you've touched on this a bit already, but why don't you talk a little bit about not just how you identify add-ons, but when? Do you go into the platform with a long-term perspective on what else you can do in the space in terms of rolling things up? Do you buy the platform and then focus on that and then figure out where to go from there? And similarly, in light of COVID, how might your process, your filtering process or your prospecting process, how might that have changed, and how effective have you been?
Yeah, I mean, good topics. The way we think about it is, we're thesis driven. So we have a good criteria set of what we're looking for the platform. So when a platform, we can benchmark against that criteria. And from there, in the due diligence phase, we start ramping up add-on acquisition efforts, like identifying companies, start reaching out to folks. In a number of cases, we'll use or engage with a buy-side firm to help, add some arms and legs to that. But really what we're trying to do, and because we're buying, companies, 5 to 15 of EBITDA, they're incomplete in some manner, either from a, geography standpoint or a capability standpoint, or the like. So filling in the gaps, trying to target companies that could add to the platform that we're trying to build. So we usually running start at add-ons, going into a platform investment, and we start bringing those along as quickly as we possibly can. As it relates process, I think one thing we've done with this managed IT services that we own,
Domain Technologies,
is we invested up front in an actual business development resource. So not just folks at Frontenac helping out on the M&A pipeline for the company, but we have a full-time person in the business who is only focused on M&A efforts. Part of their responsibility is integration, but now that we've scaled, we've actually added a full-time integration person building an M&A team at the business here, just given how important the acquisition consolidation effort is, which isn't always the case across our portfolio, but here, and given the nature of the size of many of these MSPs, you just need additional resources because the volume of deals are going to be, you may see at another platform company where maybe you're doing one or two over 4 or 5 years.
So that looks like sort of like an ops consultant who's purely wearing an integration and maybe a little bit of a corp dev hat.
That's right. It's kind of that corp dev M&A background with some experience on the operations side. Probably less so on the financing side, which is where we help a lot, but really in the business, understanding how these add-ons are going to come into the company and fit and integrates, if there's savings opportunities or if there's cross-sell opportunities, and what it takes to really, from a back office standpoint, get things integrated under 60, 90 days.
Mm-hmm. Chad, how about you?
Yes, a lot of similarities there. I mean, one of the companies I would highlight that we own has been pretty aggressive on the M&A side. It's a company called Great Plains, and they've done a couple of bolt-ons since we acquired them back in 2018, late 2018. So we're now kind of 2-3 years into it, and somewhat similar. I think when we first acquired the company, M&A was a part of the thesis. That we had identified. Probably a couple dozen potential bolt-on candidates for the company before we actually acquired the company. So we knew that was going to be a part of the story. And the company had done, I think, one deal in the last couple of years prior to us taking over ownership. So I think there was a combined view from management and us that M&A would be part of the story. And then as soon as we took control of the company, we started working with management to refine that pipeline list and started an outbound calling effort. And so in that case, Grain ended up sourcing the 2 deals they ended up doing. But along the way, the CEO from the first deal stayed on and became our head of corporate development. And so we started, an internal and somewhat, similar to what Joe was describing, an internal corporate development arm within the company that could augment what we're going to do or what we were doing at Grain, so that scale could start growing on both sides. And I think that's been a really good partnership between the two. I think right now we don't have a formal integration person within the company. That resource is really a combined effort between Grain. We have an operating partner kind of model within Grain where we have a team of consultants, operating consultants that can parachute in and help with projects, special kind of one-time projects like that. But it wouldn't surprise me over time where maybe we actually end up adding a resource like that that's dedicated within the company to continue to build out that scale.
Mm-hmm. We've spoken a little bit about valuation spreads and targeting add-ons. As it relates to the dynamic of diligencing an add-on and bidding for an add-on, curious what you guys think about the different approach you might need. Chad, you referenced the size threshold in terms of how you differentiate between a platform and an add-on. You might have a more or less sophisticated seller. You might have a more or less emotional seller. What's the different lens that you look at add-ons through when it comes to those types of dynamics, and how do you navigate that?
Yeah, I mean, it's I think we talked a little bit about size. I think every deal is a little different, right? So it's kind of hard to put a kind of a generality across all of those. And I think we have to kind of look, for us, at least in telecom, it's a very geographically defined, industry, right? In the sense that that these are physical networks in a given geographic area, and so that's probably the first lens we look at to think about platform form versus versus a bolt-on. And if a particular asset is, adjacent to or in a complementary area, and it's, of a scale and size that would make sense, for a bolt-on, that would probably be the first lens that we would look at. And then I think the desires and capabilities of the management team, I think, would probably be another stop. One, speaking on the size, one other kind of rule of thumb or thought that, having kind of worked on 40 or so bolt-ons in my career, and looking at the industry more broadly, is that relative size ratio between the platform acquirer and the target themselves. And I think there's a bit of a sweet spot, where probably somewhere, I would say, between 5 and 10% of the acquirer size range is probably starting to get on the low end. Below that, it's a really small kind of tuck in, and may not be worth the distraction of management to really kind of focus on that. And then on the higher end, I think somewhere probably in the 30 to 40 or so, 50% type range, you start getting to a size range that starts, I think, creating risk on integration. I think there certainly have been merger of equals where equal sized companies acquire each other or partner up, but there's been a long list of those that have been troubled and had challenges from a cultural perspective and otherwise. And so somewhere in that, I would say maybe 10.
Chad always freezes up right when he's getting to the best part.
Right.
Joe, why don't you jump in and share
I think for us, a lot of times I think the best add-ons we see almost represent like 20 to 30% of the EBITDA of the pro forma platform. Those are nice tuck-ins and add-ons to do. So, and I think, doing those are a lot easier than smaller deals. But that makes sense for us.
That's 20 to 30% of the EBITDA. Is that how you're measuring it?
Right. So yeah,
an $8 million EBITDA business, and your add-ons too, your combined is 10, and a nice $2 million add-on. And, like Chad said, a lot of times those folks are looking to, exit the diligence. You're really focused on, the integration side, or how these businesses come together, more than anything. And we found, kind of, it's important being upfront with some of these sellers, is that, the business, here's how we're thinking about integrating it, just so there's fewer surprises post-close. And if they are going to stay in the business, really clearly defining kind of what their role is going to be going forward. So, wish that happened after the fact, and everyone's at least, on board to start with for the plan.
Right. And something you're touching on is there's a strong interpersonal element of deal making, obviously getting in front of sellers and, having a beer with them and seeing eye to eye about things. COVID's obviously impacted folks' ability to travel. It sounds though like it hasn't really, Joe, just following up on your comment, it sounds like it hasn't really impacted your ability to develop rapport with sellers. Is that fair to say?
It's fair to say. I mean, everyone tries different things. I think COVID has allowed us to actually have more of these types of interactions with people, where you just used to hear a voice on the line. And it allows you, from our perspective, more access to people further down the organization, which, I think sellers, and especially smaller companies, careful about who comes under the tent and what. And I think in this forum, I think it's a little bit, or it creates a little bit of an easier format to get people involved in the business. But yeah, we've been traveling through COVID and we're traveling now, but there's definitely a human element of relationship building and trust building that has to occur. Because a lot of times these sellers, they've never sold their business, most of them before.
Right. Chad, probably a last question before we have to drop off, but same question for you. How have you managed to navigate the choppy interpersonal access and get deals done in that dynamic?
Yeah, I think it's definitely been a challenge, right? Like I think a lot of our lives, but I think been pleasantly surprised with the outcome, right? I think as Joe and I both highlighted, we've been able to get deals done in this environment, and so I think good from that perspective. It's probably increased even some of the interactions. I think when I think about deal flow, particularly in the last kind of 6 to 9 months, I think it's been on par, if not higher than before. A lot of those are banker-led processes, I will say, though. And I think the role of a banker in COVID has probably been, solidified as a result of this. I think it's a bit trickier on the other end of the spectrum, even though we've done a few that fit this category of that kind of off the market, out of process, more proprietary kind of deal. I think the ones we've done have been deals where we had a very strong historical relationships where, we've had multiple of those kind of face-to-face, interactions prior to COVID. And so you could build off of that. I think the categories of the deal, though, where you bump into somebody at a conference and you develop a relationship, that's a personal relationship that then leads to a deal. I think that's gotten harder in COVID just because we haven't had those informal conferences that are face-to-face or, the more speculative business development lunches, things like that. And so, I think hopefully post older owners and founders, I think for that stereotypical category, it's important to get face-to-face.
Got it. Thanks, Chad. And I think that just about does it for our panel. So thank you to everyone for joining. Thank you to Joe, Chad, and I'm going to thank Sean as well, even though his IT situation never got resolved. And enjoy the rest of the conference. Thank you.
Thanks, everybody. Take care.
Thank you.